Hi everyone, welcome back to the Finance for Riches YouTube channel. We are continuing on with our series on passive income, and today we are speaking about dividend income. So dividends are essentially the distribution of profits which a company's accumulated over time to its shareholders. There's two main ways in which you can generate or in which you can acquire shares which can pay you dividends. One is investing in a private company. So for example, you might have a business which is owned through a private corporate structure. The other way is by buying shares in a publicly listed company. So there's a range of stock exchanges all over the world which allow for the trading of public shares. And you can go ahead and acquire or sell shares in those companies. Now, when you buy shares in listed companies, there's no guarantee that you'll be paid dividend income. It's generally at the discretion of the company directors, depending on the corporate law which prevails in the country in which that company is subject to. In some cases, you'll find some companies pay higher dividends, whereas you might have companies which don't pay dividends, but you can still get gains or returns based on the growth of the shares. So you might have a company in which they don't pay as much dividends or they don't pay dividends at all. But what you get instead of receiving a dividend income stream is you get capital growth in those shares. So the value of the shares steadily goes up. The capital growth aspect of shares isn't what this particular series is looking at. It's looking at dividend income, because dividend income is what passive is a type of passive income. So in the video on interest income, what we spoke about was banks offering interest rates of X, Y, Z. So you sort of have an idea of what sort of returns available to you for your term deposit or your savings in your bank. Shares is they're slightly different, because you can't, as I mentioned before, dividends don't have to be paid by the company in which, if it's a publicly listed company, it doesn't have to be paid to the shareholders. Nor does a private one, but I suppose if you're the sole shareholder or quite a large shareholder, you have a bit more say on that. Whereas in public listed companies, you don't necessarily have a say in that. So it's a bit difficult to be able to determine what your rate of return is going to be, or forecast to predict what your rate of return is going to be for an X period of time for dividends based on your share investment. You might find if you look at companies' historical data, that's pretty consistent, the dividends which are paid year on year, but it doesn't mean if they've been paying a dividend that's 3% on a share price, doesn't mean you're going to get that again this year. So that's something to take into account when you're investing in shares and looking at dividend income stream. What you might get though from dividends, which you don't get from interest income, are possibly tax benefits. Now, I can speak on Australian tax law, and obviously whenever you're talking about tax, you should speak to your professional tax advisor about this, whichever jurisdiction around the world you're viewing this video from, because the rules can differ and probably will differ. But if you just look at it from an Australian point of view, when a company pays tax on its profits, so remember, dividends are basically accumulated profits which are distributed to shareholders. When a company pays tax on those, the shareholder can get a benefit on the tax paid, because the company might attach what's called imputation or franking credits to those dividends. And what that basically means is the company's already paid tax at the corporate rate prevailing for the company, and the shareholder gets a benefit. So for example, a large listed Australian company has a 30% corporate tax rate, 30% tax has been paid on those dividends. If you're in a higher or lower tax rate, if you're in a higher tax rate, theoretically you just pay a difference between what the company tax rate is and whatever tax rate you're at. Sometimes there's a chance of getting a cash refund from the payment of imputation credits, aka franking credits, depending on your tax profile. So that's something to take into account as well. But like I said, these rules change from country to country, so you should speak to a tax professional about those sorts of benefits. Now, the exit The exit sort of considerations are a bit more technical, a bit more difficult as well, I suppose, in predicting or forecasting. When you want to exit from a share investment which is paying you dividend income, the price the prevailing price at that time, the market value, I guess you call it, or the online trading value, that's will be your proceeds for the sale of that share. Whatever you paid when you acquired the share is the cost. So the difference between the two gives you a gain or a loss. But on top of that, you got to take into account transaction costs, because when you buy shares, you got to pay a commission to the trading platform. You might possibly have other costs too, though generally for typical mum and dad investors, those other costs are quite low, if anything at all. But if you're trading by yourself, yeah, transaction costs for your platform is what you got to take into account as well. So whether that's a net gain or net loss, that'll depend on whether your proceeds from selling the shares are higher than your cost. If it is, happy days. If it isn't, not so happy days. And again, going back to tax, if depending on the rules which apply in your country, you can get a potential benefit of being able to carry forward any losses you got from selling your shares and possibly offset those losses against other gains you make. Capital gains specifically, from an Australian tax point of view, you can only offset net capital losses or capital losses with capital gains. But of course, if you make a gain out of your shares as well, then that's subject to tax too. I don't want to go too technical on the tax side of things, because things can vary depending on whether you're not a regular trader or whether you are, because if you're a regular trader, you're going to be taxed like normal income. If you're not, it's going to be taxed like a capital gain. But these are some additional considerations which you should take into account as well when you're looking to set up a passive income stream from dividends. That's all for the dividends video, guys. Like, comment, and subscribe. Obviously, like I said before, if there's any financial topic which you want some literacy or commentary on, please comment down below. We're going to continue on with this passive income stream. Our next video will look at rental income. Alright, thank you. Bye.